Okay, good evening, everyone. Good evening, Meg. Very good evening, everyone. So I welcome you guys again to one more interesting and interactive session on the subject of financial management, which is your paper 6A in CA Inter. So in the last chapter, we have had an overview of what are the various sources of finance, right? We discussed about equity, we discussed about debt, we also discussed about uh, various forms of equity, whether it is from domestic structure or from whether it's from domestic or from whether it is international sources. And we discovered very uh, new concepts, right? So we discovered very new ways or innovative ways of raising finance as such. Okay, so now it's time for us to look into the analysis part, right, of a company, right? Now, remember this entire chapter that we are going to discuss, it's going to be purely based on uh, analysis uh, for a joint stock company. So we are going to calculate certain ratios, certain numbers, which are going to be relevant for the joint stock companies, guys. Okay. So it's going to be relevant for the joint stock companies and not for the sole proprietor or partnership, because the concepts of numbers, the terms that we are going to use, it's going to be relevant for those aspects. Okay. Now, the important part over here is uh, before we go ahead with the ratio analysis part, we will first get our certain basics clear, basic concepts we need to be clarifying before we go into any sort of discussions about the ratios. So let us have a look at understanding of the balance sheet in a quite different way. Okay, so we'll be looking for like the balance sheet, not from a traditional concept, traditional point of view, but we will be looking at it from a very different perspective. And it's going to be really interesting to see how those things are going to work out. Okay. So let us see certain aspect from the understanding of the balance sheet point of view. So let's say fundamental balance sheet equation. We all know that when we talk about the fundamental balance sheet equation, um, how many sides does a balance sheet have, guys? How many sides does a balance sheet have? Two sides? Okay. Okay, so one of the side is called as the liabilities, and the other side is going to be assets. And we all are aware that assets and liability should be one and the same. I mean, not one and the same, but the amount should be equal. The total of liabilities and the total of assets should be equal to each other, right? So we say that liability should be equal to assets. Now, taking it further, instead of saying that as a liabilities, I would like to, name it a different way. Just think of what all things does your liability comprise of? What all things, what all items do you have on the liability side of your balance sheet? Can you just think of what are the items that you have on the liability side? Can you name few of them? Name few of the items that are there on the liability side of the balance sheet. Equity, okay. Then only equity, preference share, trade payable, borrowings, okay. Debentures, creditors, debentures, perfect. Now from that, just for the time being, no, forget about the current liabilities. All your long-term sources of funds, like your equity, all your long-term liabilities, like your equity, your debentures, your borrowings, they can actually be said to be sources of funds, right? So ideally, whatever funds you have raised from multiple sources, whatever sources you have, sources of funds should be equal to application of funds. Sources of funds should be equal to application of funds. Right? So liability should be equal to assets and sources of funds should be equal to application of funds. Now, when we say sources of funds, it comprises of two parts. What are the two broad categories of sources of funds? Can you tell me? What are the two broad categories of sources of funds? Two broad categories of sources of funds. Long term, short term? No. Not short term, I'm not calling it as a source of fund. Sources of funds can be either like owned funds plus borrowed funds, right? The sources of funds will comprise of owned funds and borrowed funds. And ideally, the sources of funds, which is your owned funds and borrowed funds, they should be equal to, okay, that should be equal to all your application of funds. No, whatever money you're raising by way of owned funds or borrowed funds, uh, that can be applied into broadly investment areas. Now, what could be the areas of investment? First up, it could be non-current assets, right? So non-current assets, okay, plus non-current assets plus we can have the other aspect as current assets, or I'll call it as net current assets. So non-current assets plus net current assets, right? And any sort of investments, So owned funds plus borrowed funds will be equal to non-current assets plus net current assets plus investments, right? So this is like the initial two areas, which is your owned funds and borrowed funds, right? Owned and borrowed, both of them together are funding these application of funds, right? Now, can anyone guess me, or not guess, but just can you tell me what will be included in owned funds? What will be included in owned funds? Yeah. If I ask you, go to the balance sheet and calculate the owned funds, how are we going to calculate that? If I ask you, go to the balance sheet and calculate the owned funds, how are we going to calculate the owned funds value? Yeah. Owned funds will comprise of equity share capital plus preference share capital and plus reserves. But we're also going to subtract the fictitious asset. Fictitious assets will be subtracted. Okay. Now, a quick question to you. Can you tell me what is a fictitious asset? Can you tell me what is a fictitious asset? What is a fictitious asset, guys? Yeah. What is fictitious asset? Deferred revenue, asset, preliminary expense. Okay. preliminary expense. Okay, any sort of item which is placed on the asset side of balance sheet, which is actually not an asset. That's what we call it as a fictitious asset. Getting it? So any sort of you know um, any sort of asset that we have on the balance sheet side, but which is not actually an asset. I mean, you can't sell it and get some value for that. For example, preliminary expense not written off, right? Or negative P&L balance, negative profit and loss account balance. So that's shown in the asset side of the balance sheet sometimes, right? So those are your fictitious assets. Now these are the assets, which cannot be sold in the market for a value. They are actually not an asset, right? So we're going to subtract that, or I can simply say reserves are netted off against the fictitious assets. Okay, so that's your owned funds. Now, if I ask you what is equity shareholders funds, what do you mean by that? What all things are included in the equity shareholders funds? Equity shareholders funds will comprise of equity share capital plus reserves minus fictitious assets. Okay, so that's going to be equity share capital plus reserves less any fictitious assets. So that's your equity shareholders funds, guys. So equity shareholders funds is going to comprise of the share capital plus reserves minus the fictitious assets. Okay. Now total certain terms that we are going to look at is sometimes we'll use the term called as total capital employed. Total capital employed or total capital invested in business. Total capital employed or total capital invested in business. That's going to be owned funds plus the borrowed funds. Or you can say also the total sources of funds. Okay. And one more important part is, any idea what's net current assets do we mean? What do you mean by net current assets? What do you mean by net current assets? Yeah. So net current assets will be calculated as net current assets will be current assets minus current liabilities. Okay, so these are certain basic terms that we will need to be referring to in the next upcoming ratios. Okay, fine. So there are multiple areas from which a business can be analyzed when it comes to its financial health, right? So for example, if you go to a doctor and ask for, perform a health checkup, is the doctor going to give you a one single number? And based on that one single number, can you just draw a conclusion that you are healthy or unhealthy? Can you do that? Just a thermometer reading, is it going to tell whether you're healthy or are you having any disease? No, right? You need to be performing various tests. So your blood pressure, your heartbeat, your oxygen level, your body temperature, your RBC count, WBC count. So there are many different medical terms that we use generally to arrive at before we draw a conclusion in which area we are lacking. So similar lines, we cannot be drawing a conclusion about a company based on based on just one or two numbers. we need to analyze the company from different perspective. We need to analyze the company from different perspective. Uh, Now, that different perspective would be like your liquidity, your profitability, solvency. So all those aspects need to be taken care of. So one aspect that we are going to look at right now is liquidity of a company or solvency. So what do you mean by this term, liquidity or solvency of a company? What do you mean by liquidity or solvency of a company? Liquidity or solvency of a company. Well, liquidity or solvency simply means what is the ability of the company to honor their obligations. So, how able the company is to honor its obligations. So, honor its obligation means whatever are your obligations, uh, whether you are repaying any debt, you want to pay your creditors, you want to clear off your current liabilities. It's simply understanding whether you will be able to honor them or not, right? So, what is your ability? How much you are able to honor those obligations? That's what we simply mean by liquidity or or solvency, right? So, whenever any creditor demands money, you should be having sufficient funds with you to honor those obligations. Okay. Now let us consider two companies, guys. So one company is having, let's say, current assets. X Limited is having current assets of 1 lakh. Y is having current assets of 10 lakh. Now tell me, out of these two, X Limited and Y Limited, X Limited 10 lakhs and Y Limited, X Limited 1 lakh and Y Limited 10 lakh. What do you feel? Which of these two companies are more capable of honoring the obligations? Which of these two companies are more capable of honoring the obligations? Which one is having a greater ability to honor its obligations? Okay. Now let me just put some other numbers in front of you. Let's say their current liabilities. Let's say their current liabilities. We have this as 50,000 and this is 9 lakh 50,000. Now tell me which of these two companies, or I say net current assets, is 50,000 in both cases. Now tell me which of these two companies do you feel is having more ability to honor the obligation? Which of these companies are having a greater ability to honor their obligations? Yep. What do you feel? X Limited or Y Limited? Or is it like both of them are having the same level of ability, guys? Same level of ability? Are they same or is it X Limited? Well, you can't be saying that both of them are having the same level of ability because the current ratio is clearly different. Now, what we are trying to calculate over here, current ratio as, so we are not going to look at the absolute number of current assets. We are going to look at the relative value in comparing both current asset and current liabilities. So current ratio is current asset upon current liabilities. So it's current assets upon current liabilities. Okay, so current ratio is current assets upon current liabilities. So it is 2 over here. Here it is 1.05. Okay, so let's try to understand what's the meaning of this. What's really the crux of this particular number. Well, this current ratio of 2, it simply tells you that current assets are 2 times of its current liabilities. Or see, current assets are 2 times of its current liabilities. Okay, so current assets are 2 times of your current liabilities. So current assets are 2 times of its current liabilities. Okay, so current assets being 2 times of its current liabilities, that's your first company. And when we look at the second company, for the second company, we get this number as current assets is how many times of its current liabilities? 1.05 times. So current assets are 1.05 times of its current liabilities. So where do you find that there is a greater cover? Where do you find that there is a greater cover, guys? X, right? Because the current assets are double of that of you know current assets are simply double of current liability. So you get a better comfort over there that even if you lose certain percentage of current assets, still you will be able to fulfill the bad debts or fulfill the obligations. So for example, let's say if I ask you, if 10% of current assets are lost due to bad debts, okay, so if your 10% of current assets are lost due to bad debts, so in case of X limited, and in case of Y limited. So in case of X limited, what will be the amount of current assets that you're going to have? If 10% of current assets are lost, let's say 10% of your current assets are lost. So what will be the value of current assets that X limited has now? Can I say it is having 90,000? So liabilities are still, uh, 50,000. So now my question is, can current liabilities be honored? Can the current liabilities be honored, guys? If your X limited is 90, and of course, yes, it can be honored, right? Because we find that to pay 50,000, we definitely have a good amount of 90,000 as current assets. But what will be the value of current assets if 10% of current assets are lost? What will be the value of current assets if 10% of current assets are lost? Hmm? Can I say 9 lakh? But your current liabilities are still 9 lakh 50,000. So can the current liabilities be honored? Can the current liabilities be honored, guys? No, it can't be honored because your current assets are falling short of current liabilities. So the idea is we should not be looking at the absolute number of your net current assets to decide whether you are, uh, having enough liquidity or solvency or not. So what's the thumb rule? So what's the thumb rule? Uh, what current ratio indicates better liquidity? Of course, high. So higher current ratio means better liquidity right? So higher current ratio means better liquidity. But then let's say we have another company called as Z Limited, with current assets of 1 crore, current liabilities of 10 lakhs. So net current assets is, you know, 90 lakhs, and then you have a current ratio also as 10. So it means now your current assets are 10 times of its current liabilities. So now the current assets are 10 times of the current liabilities. So what do you feel? Is it good about this company Z? What about the liquidity that the company Z is having? Very high liquidity, right? So good level of liquidity is there with the company, very high level of liquidity, right? But do you sense any problem in such situation? Do you sense any problem in these situations? Do you sense any problem in this situation, guys? Yeah. Yes. What's wrong? A very high current ratio. What is it that's wrong with this particular high current ratio? What is it that's wrong with this very high current ratio? What do you feel? Yeah. What's your take on it? What do you feel? Well, high current ratio means better liquidity, definitely. But very high current ratio means there is something wrong. Now, what could be that wrong thing which is there for a very high current ratio? First, tell me, why would a current ratio be very high? What could be the reasons for that? First up, you can have high level of stocks, right? Or second thing, you can have high level of debtors, right? What could be the other reason? What could be the other reason? You can have high level of cash. So high level of stock, high level of debtors, and also high level of cash, right? So you have high level of stock, high level of debtors, and high level of cash. So if you're having greater amount of stock, what does that indicate? Can I say, if you're having a higher amount of stock, it means there is selling inefficiency. You're not able to sell your stock at a faster pace. So you're just accumulating the stock with you, right? So there's a selling inefficiency. What would high level of debtors indicate this? What would high level of debtors indicate? So if a company is having a very high level of debtors, what does that indicate? What sort of efficiency is it having? Can I say collection inefficiency? So high level of debtors indicate there is a collection inefficiency. And if you have a high level of cash, then there is investment inefficiency. So you're having a high level of cash, it means you're having investment inefficiency because you're not able to invest money in an efficient manner. So you're not able to invest money in an efficient manner. That's your investment inefficiency. So high level of stock means selling inefficiency. high level of debtors means collection inefficiency, and high level of cash means investment inefficiency. So now the real question is, sir, you said low current ratio is indicating lower solvency. High current ratio is indicating inefficiency. So what should be the current ratio then? What should be the current ratio, sir? Ideal current ratio that we say is for your manufacturing entities. So for manufacturing entities is 2:1. So we say ideally the current ratio for a manufacturing entity should be 2:1. Because if you have a current ratio of 2:1, you can say you're safe in between, you're safe in a trading of the liquidity and that of the inefficiencies. Got it, everyone? Are we good? Yes, perfect. Okay, great, guys. Now, let me demonstrate one more important aspect to you. Let's say we have certain level of current liabilities, and then we have current assets. Okay, so we have like creditors to be paid off as 2 lakh. Okay, and we have cash on the asset side. Let's say we have cash and cash equivalents as 30,000. Then we have marketable securities, 20,000. Debtors, 1 lakh. Inventory or stock as, let's say, 2 lakh. And prepaid expense is 50,000. Okay. So we say that total current assets is 4 lakh. Total current assets is 4 lakh. And our total current liabilities is 2 lakh. The total current assets is 4 lakh. Current liabilities is 2 lakh. So what's the current ratio over here? What's the current ratio is? What's the current ratio over here? Can I say it's ideal 2:1? So current ratio, ideally it is 2:1, right? So our current ratio, ideally it is perfectly 2:1. Okay. So there shouldn't be any problem. Now, let's say if such a situation arises that creditors make a demand of the amount due to them, which is 2 lakh. How are we going to make payment of this 2 lakh? Yeah. How are we going to make the payment of this 2 lakh, guys? I know it is going to be from assets, but then which asset are we going to use initially to pay this creditor's demand? Cash, right? So let us say we pay the cash and cash equivalent. Let's say of 30,000. So we paid off the cash and cash equivalent as 30,000. Okay, so cash and cash equivalent 30,000 is something that we have paid off, right? Then next is marketable securities. right? We can definitely sell these marketable securities in the market and we pay off 20,000. Now we still have 1,50,000 to pay to the creditors. How do I make this payment now to the creditors? Because their claim is not fully, satisfied. The claims of creditors is not fully satisfied. So how do we pay it? Now we have definitely used the cash and cash equivalent and marketable securities. That's not enough to fulfill the creditor's demand. So how do I fulfill it? How do I fulfill it? Yeah, shares. What? Where are the shares? Okay, one thing we can uh, do is go for the debtors and ask for the money. But then when it comes to debtors, the money may not be paid to you immediately because you would have sold goods to the debtors with certain credit period, right? You would have told them that, okay, you can pay me after 60 days. Now, before the expiry of 60 days, if I go to the debtors, they will not be ready to pay me. But one thing I can do with regards to debtors is we can ask for a bill to be signed from them and we get a bill receivable from debtors as discounted. So debtors was 1 lakh and let's say after discounting, we received 98,000. We still have this 1,50,000 minus 98,000 as 52,000 balance to be paid. Will I be able to pay this 52,000 of balance with the stock? I can't return back the stock to the creditors, right? And creditors would obviously shout at me, then why the hell have you borrowed, have purchased stock from me? So it's like I cannot take back the stock. I cannot give back the stock to the creditors and say your claim is fulfilled. And then the other thing arises is let's go to the bank and ask for a loan against the stock. Now that will again take some process, right? That by the time that happens, probably you will be able to sell the stock and get. But the thing is, we'll have to make the payment in a short span of pay. So we can't sell this stock, and neither can we, settle off this. How to say prepaid expenses. So both these items are sort of current assets, but they are actually illiquid current assets. They are illiquid current assets. Now, why do we call it as illiquid current assets? Because you can't be uh, getting them converted to cash easily. Prepaid expense, of course, you can't get it converted to cash because prepaid expense is something that you have paid in advance for the future years. Now, you cannot transfer it to your creditors and say that, okay, you keep the prepaid expense money with you. That it's not possible. The prepaid insurance, it's not going to be of any use to your creditors. So these two items, stock and prepaid expense, they are illiquid current assets. They are illiquid current assets. Okay. So we need to revise our current ratio. We need to revise our current ratio to be making it, more strict so that we can make it a more strict term. So therefore, we have to look at certain new ratio and that's called as the liquid ratio or quick ratio or acid test ratio. Liquid ratio, quick ratio, or acid test ratio. That is going to be a revision to our current ratio. So in current ratio, we simply took current assets upon current liabilities, but we realized that current assets has got certain illiquid assets or illiquid current assets. We need to remove from the numerator. So they are going to remove from current assets stock and prepaid expense. Right? So current assets minus stock minus prepaid expense. and then you divide it by current liabilities. Current assets minus stock minus prepaid expense upon current liabilities. That's going to be your liquid ratio, quick ratio, or acid test ratio. Then absolute, another strict term, more stricter value, is absolute liquid ratio. Absolute liquid ratio is cash and cash equivalent plus any marketable securities. So we are going to consider in this formula only highly liquid current assets, right? So in the liquid ratio or quick ratio, we included debtors also. But when it comes to absolute liquid ratio, we're making it even more strict by including only those assets which can be easily converted to cash without any significant loss in the value. Okay. So that's your three ratios to measure the short-term solvency, guys. Now, the question is, in current ratio, we said that the ideal should be 2:1, but we know in spite of current ratio being 2:1, we failed to honor the obligation. So we came up with these two additional ratios. So what do you think? What should be the ideal liquid ratio, guys? Ideal absolute liquid ratio and or ideal liquid or quick ratio? What do you think? What should be the ideal liquid ratio? 1:1, yes. So absolute liquid ratio, you can say ideal absolute liquid ratio is 1:1. Okay. Perfect. So that's about the short-term solvency. But one perspective to measure the short-term solvency is to simply compare the assets and liabilities, right? Another perspective to that is to really check how much of quick assets do we have, or how much of cash do we have to bear our day-to-day expenses. Okay, so let me just make you understand this with the help of an example. So let's say there are two guys, there are two people, Mr. A, Mr. B. Cash balance that Mr. A has got is 1,000, and cash balance which Mr. B has got, that's 700. So what's the cash expense? Now, if I ask you, which of these two persons, A or B, who is having a greater liquidity, guys? Who will be able to honor the day-to-day expenses easily? A or B? Well, you can't be answering that unless and until you know what's the amount of daily expense that you need to incur. Okay. So unless and until you know what is the daily amount of expense you need to incur, you can't be really sure about who is going to be more, having greater liquidity. So cash expense per day. Let's say over here the per day expense is 100 and this guy has got a per day expense of 35. Now tell me which of these two persons is having a greater liquidity, or who will be able to survive in a better way? Who is having a greater chance of uh, you know, paying the obligations? B, right? Because you see the expense is low for Mr. B. So how do we compare that? So we can simply compare it as by saying how many days of cash expense is available as cash balance. So I'm asking you, how many days of cash expense is available as cash balance? Right? Every day you have 100 as an expenditure, you have got 1,000. So if I ask you for how many days are you going to survive on this cash? For how many days you will be able to survive on this cash? Mr. A is going to survive for how many days, guys? If the cash balance is 1,000 and cash expense is 100 per day. So for how many days is the person going to survive? 10 days. Absolutely right, guys. What about Mr. B? Mr. B is going to survive for how many days? Hmm? Mr. B can survive 20 days, right? Because it's simply 700 divided by 35. So how did you calculate these numbers, by the way? Can I say this was simply done as 1,000 divided by 100, and this was calculated as 700 divided by 20, right? So this guy is having less liquidity and this guy is having more liquidity. Just as we did for a person, we can similarly do it for a company also. So that number which you said over here, 10 and 20, similar number, we can calculate similar number. We can calculate for uh, a company. For similar number we can calculate for uh, an entity also over here. So that is done by a ratio called as basic defense interval ratio. Basic defense interval ratio, which is calculated as quick assets upon daily operating expense. And remember, this is going to be measured in days. This is going to be measured in number of days, guys. Okay, so quick assets upon daily operating expense. That's your basic defense interval ratio. Quick assets upon daily operating expense, right? So now quick assets, we know. How do we measure this quick or basic defense interval is going to basically tell us the number of days for which operating expense can be paid without any funding. So without any funds being raised, without any new funds coming to you, you will be able to survive for how many days? That's going to be like, as you did over here, cash upon daily expense. Same way, you're going to consider quick assets upon daily operating expense. Okay. So this is going to be cash and bank balance plus marketable securities right, plus net receivables, right? And this is going to be divided by daily operating expense. Now the question is, how do we calculate this daily operating expense? How do we calculate this daily operating expenses? How do you calculate the daily operating expense? Yeah, daily operating expense. Daily operating expense. Total expense for the year divided by the number of days. That's obviously fine. But how to calculate the total operating expense for the day? So we take like COGS plus all the expense. We need to include all the expense, right? So this is going to be COGS plus admin expense plus selling expense less depreciation and non-cash expense divided by 365. That's your daily operating expense. Now remember, in COGS, in admin and selling expense, whatever your non-cash expenses are there, like your depreciation, amortization, or any sort of provisions, all those things needs to be removed from your expense. And then you divide it by 365 because we need the expense that you're going to pay by cash. So that's your daily operating expense. Okay, fine. Uh, let me just give you a quick question. Suppose cash and bank balance is 20 lakhs. Marketable securities is 8 lakhs. Receivables are 70,000. Sorry. Receivables is 14 lakhs. Okay. And I give you information like COGS is 1 crore. Admin expense is 20 lakhs. Selling expense is 10 lakh. Depreciation is, let's say, 12 lakh. Okay. And provisions are, let's say, 6 lakh. Calculate the basic defense interval ratio, guys. COGS is cost of goods sold. Actually, COGS is cost of goods sold. Yes. Tell me, guys. Calculate the basic defense interval ratio over here. use the numbers, use the formula, and then calculate the basic defense interval ratio. Calculate the basic defense interval ratio, guys. One 3691. Okay. Okay. So first we need to calculate the daily operating expense. The daily operating expense will be your COGS plus admin plus selling less depreciation and less provisions. This divided by 365, which will give us 30,684 as a daily operating expense. And we have the total current assets, total quick assets rather, I can say. Sum of all three of them, right? Correct? Okay. So daily operating expense is this, and your total quick assets is this. So what will be basic defense interval? That will be quick assets divided by 30,680. Okay, that's 136.875. Absolutely correct. Okay, great. Now, this is where we were looking for short-term solvency. Now let's how quick assets are made. Quick assets are cash and bank, marketable securities, and receivables. These three items, right? Okay. Now let us look for the another aspect uh, wherein we are saying how do we go about measuring the long-term solvency. These were like short-term solvency, your current assets and current liabilities and your ability to pay the short-term liabilities were considered. Now we will look at, and then we look at like the long-term solvency. Long-term solvency is whether we are able to honor the long-term obligations or not. How good uh, is, how good we are when it comes to long-term solvency. So for that, let's not directly go for the ratio calculation. Rather, we'll take take some numerical examples, and from that, we'll try to understand how do we measure those ratios. So let's say X Limited and Y Limited, we're having two companies. Equity share capital, 10 lakh, and here it is 7 lakh. Preference share capital is 5 lakh and 6 lakh. Reserves is 15 lakh and 10 lakh. Debt is 13 lakh and 20 lakh. So we have the total capital employed. Total capital employed is for X Limited, total capital employed is 43 lakh. This is also 43 lakh. So total capital employed by both the companies are just one and the same. Just their capital structure are a bit different. I mean, the amount of equity and debt they have, that's difference in it. Otherwise, total capital employed is just one and the same for both the companies. And then, of course, the total assets that we have, which we have, funds invested, it will be like non-current assets, 30 lakhs. And let's say current assets, these net current assets is 13 lakhs. Then we have total funds invested. Total funds invested is 43 lakhs. Right, so total funds invested is 43 lakhs. Okay. Total funds invested, we are having 43 lakhs, correct? Now, let us look at how good each of these companies are when it comes to the long-term solvency, guys. So one ratio, again, before we go to any sort of ratios, any one of you or someone, anyone can just tell me which of these two companies do you feel are having a greater degree of long-term solvency or lesser degree of long-term risk? Because as the solvency is higher, risk is going to be lower. Which of these two companies, just by looking at these plain numbers, can you tell me which of these two companies are having a greater long-term solvency, guys? Yeah. Which of these two do you feel are having a greater degree of long-term solvency? Okay, X is having a greater. Okay. Okay. More reserve, less debt, X. Okay. Well, broadly, you can say X is having a better solvency. Maybe by simply looking at the amount of debt because it is having lesser debt, higher degree of reserves, and also, share capital and preference share capital is also higher, right? So let's look at certain ratios, which are going to tell us about all these aspects. So first, let's talk of equity ratio. Okay, so equity ratio, it is going to tell us proportion of net assets funded by equity shareholders. Proportion of net assets funded by equity shareholders. So equity ratio is going to be calculated like your equity shareholders funds divided by the assets. Okay. So equity shareholders fund divided by the assets. So we can say equity shareholders fund divided by assets. It means equity shareholders fund is going to be comprising of what? Equity share capital plus reserves, right? So equity share capital plus reserves divided by the total assets of 43 lakhs. Now, same way, we do the calculation over here. 17 lakh divided by 43. So this number comes out to be like 25 lakh divided by 43 lakhs. And this is 0.395. Okay. So for rupees 1 of investment, we can say for rupees 1 of investment in the company, 0.5814 0.5814 is from equity shareholders, right? So we can say it has come from equity shareholders. Now, similar lines, if I just compare, so for rupees 1 of investment in the company, 0.5814 is from the equity shareholders. And same thing over here, we can say they are having 0.3953 from equity shareholders. So for rupees 1 of investment in the company, 0.3953 is from the equity shareholders. So we can just say level of long-term solvency. Here it is going to be high and here it is going to be low because you're having a greater proportion of your assets being funded by equity shareholders or from owned funds. So that's going to give you a greater degree of long-term solvency. And on the other side, you have a lesser amount of equity fund. It means you're having a greater proportion of borrowed funds. And that's going to be giving you a long-term solvency to a lower degree. Then we have debt ratio. Debt ratio is simply calculated as total debt divided by assets. So this is going to tell us what is the proportion of assets funded by loan or funded by borrowings, right? So this debt ratio is going to be like your borrowings divided by the investment, right? So the number is calculated to be 0.3023 and this is 0.4651. And if you talk of the interpretation from this point of view, we can say for every 1 rupee of investment in the company, 0.3023 is from debt. And this is going to be like 4 rupees, 1 of investment in the company, 0.4651 is from the debt. Okay. 0.4651 has come from the debt. So, of course, the long-term solvency, if I ask of what is the level of long-term solvency, here it means, of course, high and the other side is going to be low because lower proportion of debt indicates that borrowed money is lower. So, you have borrowed less money or you're using more of your owned fund. That indicates you are in a better safe situation. Okay. Similar line, we have one more ratio because in case of equity ratio, we consider only the equity shareholders funds. But there is another category of owned funds also, which is invested into the company, and that's a preference share fund. So we look at proprietary ratio. So proprietary ratio is calculated as, well, the formula is owned funds upon assets. So proprietary ratio is owned funds upon assets. So owned funds is going to be your equity share capital owned funds going to be equity share capital plus preference share capital plus reserves. Right, and this divided by the asset value. Asset is 43 lakhs. So it is 23 lakh upon 43, 30 lakh upon 43 lakh. And this is going to be 23 lakh upon 43 lakhs. Right. So we get this proprietary ratio as 30 lakh divided by 43 lakh. And this is 0.5348. So can you tell me now what is the level of long-term solvency? Of course, the first one is having a greater degree of long-term solvency because of its higher long-term solvency, because of its higher, simply we can say, higher proprietary ratio or more proportion of your funds are coming from your own sources. Okay. Next is debt equity ratio. Debt equity ratio. Debt equity ratio is simply calculated as, borrowed funds upon equity shareholders funds. Right. So I can calculate over here borrowed funds, which is your debt, divided by equity shareholders funds will comprise of share capital plus reserves. That's 0.52 and 1.17. So here the interpretation is for rupees 1 of equity, company has borrowed rupees 0.52. Company has borrowed rupees 0.52 of debt. And for other case, it is for every 1 rupee of equity, company has borrowed 1.17 of debt. Now it is quite obvious that second formula, in the second case, the proportion of debt as compared to equity is significantly higher. Right, it's more than what your equity is. So that indicates that the other company is going to be having a lower degree of solvency. So you see what's the higher degree of solvency and a lower degree of solvency, just looking at the debt equity ratio, right? Are we good, guys? Are we good till here? How to measure the solvency, long-term solvency, guys? Yes. So one, we have the equity ratio, then we have the debt ratio, then we have the proprietors ratio, and then the debt equity ratio. Next ratio, just before we understand the next ratio, we need to look at certain return ratios, and then we are going to do something interesting, about financing of the companies. Okay. So before we go to those ratios and the interesting aspect, let's just take a break right now. Okay, we'll take a break of around 15 minutes, and then after that, we'll meet for discussing some new ratio. And then after that, we'll look into one important ratio for analyzing the long-term solvency. Okay, so let's take a break now, guys. Okay, welcome back, guys. Are you all there? PPT of first lecture, it will be done today, don't worry. Today or maybe tomorrow. Just put it into proper format and then I just upload it, okay? Okay, so let us go for now. First, understanding a bit of income statement, and then we will, take it forward or take it further for discussion um, about the next solvency ratio, long-term solvency. Now, let me just present before you an income statement. So we start with sales. Let's say sales is 20 lakh and we will subtract variable cost from that. So sales is 20 lakh and we subtract the variable cost. So let's say variable cost is 8 lakh. Now, what is it that's remaining after subtracting variable cost from sales? So from sales, when we subtract variable cost, what is that term called as? What is the term called as? Sales less variable cost. What is the term called as? Contribution, right? So contribution is 12 lakh, right? Further, we subtract, let's say, fixed cost. So fixed cost is, let's say, 4 lakh. After subtracting this fixed cost and variable cost, the term that we get is earnings before interest and tax. Okay, that's called as EBIT or earnings before interest and tax, or also sometimes called as PBIT, which is profit before interest and tax. Okay, so that's your earnings before interest and tax, which amounts to 8 lakh. Okay, now remember this earnings before interest and tax number, up to this area, we call it as this area is said to be the, up to this part, we call it as operational. Right? So this is your operational income statement in which we are including all your operating income and we are subtracting all the operating expenses. So we're including all your operating income and we are subtracting all your operating expenses. So this particular 80,000 is your operating profit. And operating profit, this is going to be something else also. We'll discuss that later. So that's your operating profit, 8 lakh. Now, this operating profit is not the final profit which our shareholders are going to get. Operating profit is not the final profit which our shareholders are going to get, right? Because since it is earnings before interest and tax, what do I need to subtract so that I reach the number which will tell me the amount to be given to the shareholders? I mean, earnings for your shareholders. You have to deduct interest and tax. So we will deduct interest, which will give us profit before tax, further less tax, which will give us profit after tax. So let's say interest is 3 lakh and PBT is 5 lakh. Tax is, let's say, at the rate of 30%. So this into 30% is the tax, and your PAT is going to be PBT minus this tax, which is 3,50,000. Okay, so this is your profit after tax. From this PAT, we will subtract preference dividend. So preference dividend is, let's say, 1,20,000. So what's the net profit for equity shareholders? Net profit for equity shareholders is 35 lakh minus 12 lakh, which is, sorry, 3 lakh 50 minus 1 lakh 20, which is 2 lakh 30,000. Now, remember this particular portion that we have, that is up till this stage. This is your financing part, right? So this is your operating profit, and this is net profit for equity shareholders is the earnings for equity shareholders. This is the amount of earnings for equity shareholders. Can you tell me what is the term that I can say to be representing earnings for owners? Earnings for owners. What will be the earnings for owners? Which of these terms would be representing earnings for owners? Owners. Earnings for owners. Yeah, owners. For owners, it is essentially this one, guys. Profit after tax. This is the earnings for all owners. This is for all net profit, or I can say these are earnings for all owners. Now, what is the term which indicates the company has earned for all its fund providers, all its financiers? Basically, for all the equity shareholders, for all the preference shareholders, for all the debenture holders, what is the profit that the company has earned? What is the profit that the company has earned for all the owners? EBIT, absolutely. So this is your operating profit, or I can say this is the profit or earnings for all financiers. So operating profit or earnings for all finances. That's your operating profit, or what we call it as earnings for all finances. So earnings before interest and tax, that's going to be your operating profit, or what we call as the earnings for all financiers. Got it, guys? Yeah. Okay. So 3 levels of profit we are saying. This portion is your operating profit, or what we call it as EBIT, and this is the earnings that we have for all fund providers. Now, profit after tax is something that we have earned for all our owners, and net profit for equity shareholders is obviously the profit for the equity shareholders. Okay, so the initial part that we have, this portion, is going to be your operational part. This is going to be determined the way you are doing business, the way you are operationally effective in terms of doing good business. And on the other side, the part beyond that is going to tell you what you're doing when it comes to financing. Okay. Now we're interested in calculating something called as the rate of return. Rate of return. Okay. Suppose I tell you that you have an income. Suppose you earned an income of 12,000 on an investment of 1 lakh. So if I ask you what is your rate of return, what's the percentage rate of return that you have earned? Percentage rate of return that you have earned. Can you tell me what will be that number? 12%, right? How do you get that 12%? How did you get that 12% percentage rate of return? How did you get 12%? Percentage rate of return, 12%. How did you get it? Can you say it is simply 12,000 divided by 1 lakh, which is nothing but 12,000 divided by 1 lakh. That's 12%. Percentage rate of return is 12,000 divided by 1 lakh, which is 12%, right? So if I ask you, what will be the formula for rate of return? So how do you calculate the rate of return? How do you calculate the rate of return? Can I say it's going to be income upon investment? So rate of return is income upon investment, right, guys? Right? Income upon investment. Of course, you can say multiplied by 100 to arrive at the percentage number. Correct, guys? Right? So now we are going to look for, rate of return for different finances. So if I ask you, what's the rate of return earned by equity shareholders? I don't want the answer. I want the formula for that. Rate of return earned by equity shareholders, or which we call it as return on equity also. Return on equity. So what is the income for equity shareholders? What is the income for equity shareholders? What is the income for equity shareholders? Can I say this one? Earnings for equity shareholders, which is net profit for equity shareholders, right? So we can say this is net profit for equity shareholders divided by. Now, suppose we have equity share capital of 10 lakh, reserves of 2 lakhs, preference share capital 5 lakh, and we have a debt of suppose 25 lakh. Okay. So now my question is, what I should divide? What is the investment made by the equity shareholders? What is the investment made by equity shareholders? What is the investment made by equity shareholders? Well, it will be equity share capital plus reserves, right? So net profit for equity shareholders divided by share capital plus reserves, guys, because reserves also belong to the equity shareholders, right? So in our case, in this particular case, can you tell me what's the rate of return earned by the equity shareholders? Can you tell me what is the rate of return earned by the equity shareholders? Yeah. Can you tell me what is the rate of return earned by the equity shareholders? Yeah. We know the net profit for equity shareholders is 23 or 2,30,000. And we divide it by equity share capital plus reserves. So this is 2,30,000 divided by 12 lakh, which is 2,30,000 divided by 12 lakh, which is 19.17%. Right? So this is what we call it as return on equity. This is what we call it as return on equity, 19.17% as the return on equity. Okay. So rate of return earned by equity shareholders is 19.17%. Similarly, if I ask you, what is the rate of return earned by all owners? Yeah. What is the formula for this? Rate of return earned by all owners. What is the formula for this? It will be profit after tax divided by equity share capital plus preference share capital plus reserves. So profit after tax divided by equity share capital plus reserves plus preference share capital. So 3,50,000 divided by 17 lakh. This is 20.59%, and which is what we call it as return on own funds. So rate of return earned by owners, all owners, is PAT upon equity share capital plus preference share capital plus reserves. Right. So this is calculated as 20.59%. That's the return on owned funds. Right. Okay. Wow. The last one. Rate of return earned for all finances. Can anyone tell me what's the formula going to be for this? Rate of return earned for all finances. So we are not talking of all the finances together and the rate of return earned for them. So can you tell me which one is going to be the formula for that? Which one is going to be the formula, guys? Yeah, correct. That's going to be EBIT upon equity share capital plus preference share capital plus reserves plus debt. Okay. So EBIT is 8 lakh upon equity share capital plus reserves plus preference share capital plus debentures. This translates to 19.05%. And this is called as a return on capital employed. So which means the company has earned 19.05% for all the finances. It means the business is giving 19.05%. Then rate of return earned by all owners is 20.59%. And rate of return earned by equity shareholders, which is the rate of return that is given to only the equity shareholders, That's 19.17%. Got it, everyone? Yes. Are we clear with all these ratios? The return ratios? Yeah. Okay. Now, let us say now it's time for you to do some calculations. So equity share capital 20 lakhs, reserves is 10 lakh, debt is 0, total capital employed is 30 lakhs, and here it is like 10 lakh, 10 lakhs, 10 lakhs. Okay. Now, for both the companies, I'm just coming up with a situation. Let's say if the EBIT is 2 lakh and your debt is at the rate of 10%. The cost of debt or the rate of interest is 10%. And if your EBIT is, let's say, 2 lakh. Okay. Can we calculate the interest, PBT, less tax and PAT, and then calculate the return on equity? Can we complete this part? Can we calculate this part, guys? Yes. So just calculate and give me the return on equity numbers, guys. Give me the return on equity numbers for both A and B Limited. Tax rate, yeah, tax rate you can take it as 30%. Yeah. Okay. So here we get the interest as this into 10%. So PBT is EBIT minus interest. Tax is this into 30%. And then we have the PAT as PBT minus tax. Return on equity will be PAT divided by equity share capital plus the reserves. So it's 4.67% and 3.5%. Right. So this means which company has performed better? We can obviously say it is the company A which has performed better for its equity shareholders, right, guys? Company A has performed better for the equity shareholders. Yes or no, guys? Correct? Company A and Company B have performed better for equity shareholders. Yep. Perfect. Okay. Now let me just put it another way around now. Now for the same companies, one differentiating factor is now EBIT is now 4 lakh. So for A and B, now EBIT is 4 lakh. So just calculate return on equity in this case, guys. Now calculate the return on equity in this case. Yep. So now the PAT is 2 lakh 80 and 2 lakh 10. And if we calculate the returns, now we find the cards have flipped. Now it is company B, which is, proving to be better. Now it seems to be like company B, which is, proving to be better. Right, guys? Correct. So the now important question that we are trying to answer is, how is it happening that in one situation, one company is performing better and in another situation, the other company is performing better? in spite of having the same EBIT levels, we find that company B is performing better in the second scenario and company A is performing better in the first scenario. Now, how is it happening? It is simple, because of the debt. Now, to understand or get a better perspective, let's try to calculate return on capital employed. Calculate return on capital employed in both situations, guys. Calculate return on capital employed in both the situations. Calculate the return on capital employed in both the situations, guys. That will help us understand better why is it so. Calculate return on capital employed, guys. Calculate the return on capital employed. How do we calculate return on capital employed, by the way? We calculate it as EBIT upon total capital employed. Yeah. So over here, you say it is EBIT divided by 3. In fact, it's just same 6.67%. And over here, it is 13.33%. Right? So obviously, EBIT is same. Your EBIT is same. So return on capital employed is also same for both the companies. But still, the bottom line, which is return on equity, that's different for both the things. Now, why is it so? Why is it so? Simple. A very interesting thing to note over here is, look into these numbers. Like your return on capital employed is 6.67% and your cost of debt is, guys, 10%. It means a simple thing is happening over here, which means we have the company. The company has got debt, right? Or I can say the company is having an obligation to pay 10% interest, whereas it is earning 6.67% return. So don't you think it's really problematic for the company? On its business, company is earning 6.67%, but it is paying out, it has promised to pay 10%. Don't you think it's something problematic for the company? Right? Because the company is earning 6.67, but the rate of interest that we have promised to the financiers is 10%. It is something problematic because you are earning less and you have promised a higher rate. But in the second case, you find that you are earning 13.33% and what you have promised is 10%. So this is something which is favorable. Now you say that you're getting 6.67%. You have promised that you will pay 10%. So the difference of 3.33% is going to be from the pockets of your equity shareholders. So it is the equity shareholders who are going to be at the loss. So it is the equity shareholders who are going to be at a loss. 6.67% is something that you're earning and you're paying 10%. So you're going to be that 3.33% is going to be financed from the pockets of equity shareholders. And therefore, the equity shareholders in the second company, where they have a higher amount of debt, where they have a debt, they are getting lower return. They are getting lower return as compared to the first case. But in the second case, you will find that we are earning 13.33 and we have promised 10%. So 3.33% is the extra surplus that we have, and that is something contributes in increasing the return on equity. Right? So the simple rule that we say here, that we are going to state over here is taking debt is beneficial only if there's a condition which needs to be satisfied. So taking debt is going to be beneficial only if, tell me guys, taking debt is beneficial only if, what could be a better relation? Taking debt is beneficial only if simple return on capital employed should be more than rate of interest. So taking debt is beneficial only if your return on capital employed is going to be greater than the rate of interest. So like taking debt is beneficial in the second situation because you are earning 13.33%, whereas what you have promised is 10%. Right? Correct? Got it, guys? So we say it's beneficial to take loan if your return on capital employed is greater than rate of interest. It is quite obvious and simple logic that whatever rate of return you have promised to the equity, to the debenture holders or to the borrower, to the funds who you have raised as debt, you should earn a bare minimum or more than that so that the equity shareholders are not at loss. Right? So this, you can say, the additional funding that comes over here, 3.33%, this comes from the equity shareholders. And therefore, the return on equity shareholders gets reduced. Whereas over here, you're earning 13.33% and you're paying out 10%. So the excess 3.33%, it goes to equity shareholders. And therefore, you find that equity shareholders are having a higher return as compared to the other company. Right? Okay. So this is something, where we can connect now to an important ratio called as capital gearing ratio. Capital gearing ratio. Okay. So how many of you know driving? Let me just try to draw some sort of connection with this gearing ratio and with the driving. How many of you know driving? You guys know driving? When I say driving, I'm not talking of a scooty. I am talking of like a geared motorcycle or maybe a four-wheeler. Do you know driving? Yes? Okay. So there we know you generally, when you start uh, with the vehicle, do you put it directly in the fourth gear? Do you put it in the fourth gear and just give the acceleration and then the vehicle moves? No. Then you start with the first gear, right? So first gear, then as the speed goes like 10 or 15 kilometers per hour, then you put the second gear. Then when it crosses 25, 30, then you put the third gear. It keeps on increasing. So if you want a higher speed, can you do it with lower gear? If you want a higher speed, can you do it with a lower gear? No, you need to put it at a higher gear, right? And suppose, for example, you're driving at a high speed. Okay. Or I can say you're driving at a very high speed, and then you just try to suddenly go down the gear. Like your vehicle is at 80 kilometers per hour, and you just put the first gear. What will happen? What's going to happen, guys? The vehicle will stop. The vehicle is going to stop, right? So just like you have a higher gear for higher speed. Same way over here, a company which is having borrowing, it is equal to your gear. Having borrowing or having preferential capital for that case, right? Having borrowings or preferential capital for that case, it gives a geared effect or lever effect, right? So it is having that gear effect. So because of that gear effect, you are likely to get a higher speed or higher return on equity. Higher speed or higher return on equity is not possible with lower gear. You need to put higher gear for that. And that's where we say capital gearing ratio is obtained as. So capital gearing ratio is going to be your debt plus preference share capital upon equity share capital plus reserves. So this ratio is going to tell you about the gear that you are in. A higher gear means, of course, you're having a higher debt and preference share, right? Which means you are following a higher risk, right? And you will be able to attain a greater degree of, speed, right? So, for example, if you're driving at a lower speed, let's say 15 or 20 kilometers, and then you directly put it into the fourth gear, the vehicle will stop. The same fund over here. If your speed is higher, now when you say speed, I'm talking of return on capital employed. If your return on capital employed is higher, then it makes sense for us to take debt or to put a gear into your business. And if it's not at that speed, you need to be running your business at a lower gear or lower debt, or maybe no debt at all. Okay. Are we good? Everyone? Yeah. Okay. Fine. Yeah, Kushi? You can ask a query.
Sir, can you please repeat this again? Actually, I got confused.
Capital gearing ratio is going to tell you what is the level of gear or the risk that you're having in your business. Okay.
So, but like both the situations, there was a difference of only the rate of taxation.
Rate of?
Taxation.
No,
Because of, no,
no.
no, sorry. That here is the debt. Both in both the situations, debt is the same.
Yeah.
Like you are saying कि अगर rate of capital employed ज़्यादा हो,
हाँ
then
मतलब
only it
आपका
is
स्पीड ज्यादा है.
beneficial to take debt.
मतलब आपका स्पीड ज्यादा है. रिटर्न ऑन कैपिटल एम्प्लॉयड इफ इट इज हायर इट मींस इट्स अ हायर स्पीड. तो हायर स्पीड is going to be possible only with higher gear, right? मतलब आपका जब when you have a greater amount of debt where you have promised them a fixed return of 10%, right? You've promised them a fixed return of 10%, but you are
Hmm.
able to generate a higher return, which is 13.33%. So that gives you that additional 3.33%, right? Which ultimately benefits the equity shareholders.
Okay, sir. Thank
Okay.
you.
Yeah. Okay. Fine, guys. So with that, let's just stop here for the day. We'll meet up again possibly on Thursday, I think, yes. And we'll continue with some more ratios, and also we'll start with questions in the next class, right? So good night, guys. Take care. Bye-bye. Enjoy. Session and session. Bye.